Okay, picture this. You check your mail, maybe your email, and bam, 100 grand shows up, totally out of the blue. Or maybe that big debt that's been hanging over your head, it just vanishes, gone. Feels amazing, right? Like pure financial freedom dropping into your lap. But here's the question we're digging into today: is that free money really free when Uncle Sam comes knocking? It might not be as simple as you think. Welcome to the deep dive. Today we're unpacking those kinds of windfalls, the prizes, the awards, even forgiven debts, things that aren't your regular paycheck, but and this is the important part, they can still have pretty big tax consequences, stuff that often lands on Schedule 1 as additional income. Now, before we really dive in, just a quick formal reminder, this deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations, they're derived from the really comprehensive accounting resources you can find over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or even a seasoned professional, definitely check out the website. They've got more practice questions, video lectures, tons of support to really nail down what we're talking about today. And a big thank you to Professor Farhat for making this material available.
Absolutely. And, the default setting in the tax world often feels like, well, if you receive something of value, it's probably taxable.
Mm.
But what makes this area so, well, fascinating are the exceptions, a little twists and turns. Our goal today isn't just to list rules. It's to give you the insight to understand when you might owe tax on these unexpected gains. And, maybe more importantly, when you might actually be in the clear. It's all about avoiding those nasty surprises down the line.
Okay, let's start unpacking this with prizes and awards. Sounds fun, right?
Yeah.
Winning stuff. The basic rules seem simple enough. Get a prize, get an award, and you generally include its fair market value in your gross income. And fair value just means, what it's actually worth if you tried to sell it. Seems logical.
It does seem logical on the surface. But the real-world impact, that can be quite something.
Yeah, remember that story? Matt Murphy, the college student, back in, 2007, he caught Barry Bonds' 756 home run ball. I mean, an incredible moment, right?
Yeah.
But that ball wasn't just a souvenir. It was valued at like $600,000.
$600,000.
Sure.
For a baseball.
Exactly. So imagine catching that, the excitement.
Yeah.
Then the tax reality hits. If you figure, say, a 30% tax rate roughly on $600, that's a potential tax bill of $180,000.
Ouch.
Right. Suddenly, that free prize has a massive, maybe unaffordable price tag attached. It really drives home the point.
It really does. And Matt Murphy's situation is like the perfect illustration of the general rule. If you get something valuable, expect tax. But what's fascinating here, as I mentioned, are the exceptions. There are ways a prize or reward might not be taxable, but, and this is critical, it's not easy. All 4 specific conditions have to be met. No wiggle room.
Okay, 4 conditions. Let's break those down. What's the first one?
First, the award has to be for specific types of achievement. We're talking religious, charitable, scientific, educational, artistic, literary, or civic achievement. Think, the Nobel Prize, a Pulitzer, maybe a university's top teaching award. Really prestigious stuff recognizing past work.
Okay, so not for winning the office bake-off.
Probably not, no, unless it's a very prestigious bake-off for civic achievement. Second condition. The winner has to immediately sign it over.
Yeah.
Transfer the prize, the money, whatever it is, directly to a qualified government entity or a nonprofit. Basically, you act as a conduit. You can't personally benefit from the cash or the item itself.
So you never really get it in a financial sense. You just pass it along.
Exactly. You're just the middleman, essentially. Third, you had to be selected without doing anything yourself to enter. No application, no contest entry form, no active participation. You were just chosen.
Yeah.
Picked out of the blue based on your merits or achievements.
So no buying raffle tickets, no submitting your name, just pure selection.
Right. And the fourth and final condition. Receiving the award can't require you to perform substantial future services. They say, here's the award, but you now have to give 10 lectures. Well, that starts looking like payment for services.
And that makes it taxable income, like getting paid for a job.
Precisely. It becomes compensation, not a pure tax-free award.
Okay, so putting that all together, it sounds like for a prize to be tax-free, it really has to be almost involuntary on your part, unsolicited, recognizing past achievement, and you can't even keep it. You have to give it away immediately.
That's a good way to put it.
Yeah.
It's designed for very specific, high-level recognitions where the individual isn't personally enriched.
That definitely seems like a high bar. Most lottery wins or game show prizes wouldn't qualify then?
Not even close, typically. Those usually involve entering, and you definitely get to keep the winnings, making them taxable.
Which brings up a simpler option, I guess. If you're awarded a big prize and you just don't want the tax headache, can you just say no?
Absolutely, you can simply reject the prize. A polite thank you, but no thank you.
All right.
If you never accept it, you never have possession or control, so there's no income to tax. It's the ultimate way to avoid the liability if you don't want the prize or the associated tax bill.
Okay, interesting. Let's shift gears slightly. What about damages? Money you get because someone wronged you. You get into an accident, someone damages your business, you get a settlement. That feels different, right? Like you're just being made whole. Shouldn't that be tax-free?
That's a very common feeling, and sometimes it is tax-free, but not always. The IRS looks very closely at what the damages are intended to replace. Let's take your business example. Someone crashes into your shop. You have to close for repairs for a week. The money the insurance company pays you for the profits you lost during that week. That's generally taxable income.
Why? Because you would have earned that income anyway if the crash hadn't happened.
Exactly. The damages are replacing income you otherwise would have received and paid tax on. So the replacement is also taxed. And it's similar with punitive damages. Let's say you sue someone for damaging your reputation, and the court awards punitive damages. Those aren't to make you whole for a specific loss. They're meant to punish the wrongdoer. Punitive damages are almost always taxable income.
Okay, so lost profits, taxable. Punitive damages, taxable.
Generally, yes. The big exception, though, and this is crucial, is damages received for personal physical injuries or physical sickness. If you're compensated for medical bills, pain and suffering directly related to a physical injury, that amount is typically not included in your income.
Ah, okay. That makes sense. The IRS sees that more as restoring your health or well-being, not as an economic gain.
Precisely. It's considered a recovery of capital, your personal physical capital rather than income.
Yeah.
But damages for purely emotional distress, if not tied to a physical injury, can be taxable. It gets nuanced.
It really does. The reason for the payment is key. Lost income versus physical injury recovery. Big difference in tax treatment.
All right, now for the one that I think catches a lot of people off guard. Cancellation of debt.
Mm-hmm.
COD. Your lender just forgives your debt. Sounds like hitting the jackpot, doesn't it? Debt gone. But is it that simple tax-wise?
Usually not. The general rule for cancellation of debt is actually pretty stark. When a lender cancels or forgives a debt you owe, that forgiven amount is typically considered taxable income to you. Wait, even though no cash actually changes hands, you just owe less.
That's right. The IRS logic is essentially you receive the economic benefit of the borrowed funds earlier, and now you don't have to pay it back. That relief from the obligation to repay is treated as income. Think about a $5,000 credit card balance. If the bank just writes it off, says forget it, that $5,000 pops up as income on your tax return for that year.
Wow. And how does the IRS even know about this?
The lender tells them. They're generally required to issue a Form 1099-C, cancellation of debt, to both you and the IRS if the forgiven amount is $600 or more.
So there's a paper trail, no hiding from it.
Pretty much.
Yeah.
That 1099-C is a direct report of income.
Let's use that example you mentioned, Jane and the car loan. Walk us through that again.
Sure. Jane borrows $20,000 for a car, makes payments for a few years, then loses her job, can't keep up, defaults. She works something out with the bank, maybe returns the car, and they agree to cancel the remaining $3,500 she still owes.
Okay, so relief for Jane, definitely needed.
Yeah. But the bank issues a 1099-C for $3,500. That $3,500 gets added to Jane's other income for the year and is potentially taxed.
That feels like kicking someone when they're down. You lose your job, get debt relief, and then get hit with a tax bill on money you never even saw.
It can feel that way, absolutely. And it's not just a theoretical problem. You know, during the financial crisis around 2006 to 2009, I was practicing then, we saw a huge spike in 1099-Cs. So many businesses, especially in construction, defaulted on loans, equipment leases, things like that. Lenders were canceling debt left and right. It just highlights how widespread this can become, especially in tougher economic times.
Okay, so the general rule is tough. Canceled debt equals taxable income. But you mentioned exceptions earlier. Are there ways out of this for people like Jane?
Yes, thankfully. There are some very important exceptions. Probably the biggest one is insolvency.
Insolvency, meaning what exactly?
Meaning that at the exact moment the debt is canceled, your total debts, your liabilities are greater than the fair market value of all your assets. You're essentially underwater.
So if you owe more than you own.
Right. If you're insolvent, the canceled debt is generally not taxable, but only up to the amount you are insolvent. So if you're insolvent by $10,000 and a $5,000 debt is canceled, none of it is taxable. If a $15,000 debt is canceled, the first $10,000 isn't taxed because you were insolvent by that much. But the remaining $5,000 could be taxable income.
Okay, that seems fair. The tax code recognizes you don't really have the ability to pay tax on phantom income if you're already broke.
That's the underlying logic, yes. Ability to pay is a factor. There are other exceptions too. One involves certain types of canceled non-recourse secured loans. These are loans where the lender's only recourse if you default is the property securing the loan, like a building. They can't come after your other assets. The tax treatment gets complicated, but it's an exception.
Okay.
Also, if your main home is foreclosed upon, the tax law generally treats that situation like a sale of the home for the amount of the outstanding debt rather than cancellation of debt income. This often results in a loss or a small gain, potentially excludable rather than COD income.
Got it. Different treatment for your primary residence.
And then there's a very relevant one right now, student loan forgiveness. Specifically, for student loans forgiven by the lender between 2021 and 2025, there is a special provision making that forgiven amount not taxable income at the federal level.
That's huge. A temporary but significant relief for many people.
Absolutely. It was part of the pandemic relief measures and affects a lot of borrowers.
Okay, so pulling this all together, what does this mean for you listening right now? It means that these sudden windfalls, a prize, an award, maybe even getting out from under a death vet, they aren't just found money, they are potential income events. And
Mm.
understanding whether they are income and whether an exception might apply is really, really crucial.
It really is. It's about awareness. Knowing these rules, even just the basics, can save you from a major shock come tax time.
It turns that feeling of relief or excitement into, well, informed relief or informed excitement. You know what to expect.
Exactly. Being informed lets you plan. Maybe you need to set aside money for taxes on that prize. Maybe you realize you qualify for the insolvency exception on canceled debt. It helps you make much better financial decisions instead of just reacting when the 1099 arrives. It puts you more in control.
So let's recap the main takeaway. The general rule is pretty broad. Prizes, awards, canceled debts. Yeah, they're usually taxable income, but the key is in the exceptions. Insolvency, specific types of awards given away immediately, student loan forgiveness during this window.
Knowing those details, that fine print, can make a massive difference to your actual tax bill. It's not just academic, it's practical. And that leaves us with something to think about, doesn't it? A final thought for you. How does knowing these rules now maybe change how you'd approach things? If you suddenly won a big prize, or if you were negotiating with a lender about a debt, what would you actually do if you were the person standing there with that $600,000 baseball in your glove today? Knowing what you know now.
Good question to ponder. We definitely encourage you to continue your own deep dive. Maybe check out those resources we mentioned earlier at farhatlectures.com. They really helped shape this discussion.